All right, better start streaming. First stream, view off right on the stream. Right. That's first things first. Let's actually go over this weekly review real quick. Let me pull up the stream and see if everything's running smoothly before I do all that. I gotta make sure everything's good. This week was a little bit more difficult of a week, especially towards the end of the week, and then um, all right, yeah, we're good. And just like blowing, not really blowing, but just losing the funded accounts was a little bit more difficult. Um, but it is what it is. Let's lock in real quick. Let's go over this weekly review. Start from Monday all the way through. Let's go this jam out real quick. Play some classical. Turn off the other stuff right there like that. All right, let's go right here. Thursday, very very important day. Day where everybody was trading, and let's go right here. So let's start a new one right here. Let's go before market open, all that good stuff, and zoom out now. So if we go to like a daily perspective, my bad. Let's go to one day. To a daily perspective, you can see here we're inside of a 4 hour, or I mean a daily buy side imbalance. We have a daily Kenner's low sweep, which is very, very crucial. We also have a 4 hour PDRA, which is this 4 hour inversion that I was looking at. So here, this was more of like, hey, we need to be pushing up higher above this 4 hour inversion, breaking above this high, and continuing to the upside to then be more bullish. If we go down to the 1 hour time frame after, market open, which is at 9:30, which I'll display, I'll show you guys where we're at. All right. And as you can see here, we tried to push below this low. We failed miserably. The market, didn't break below there. And we had a failure swing. So we had a failure swing right here. Market had this failure swing. We've tried to, break below market structure. We're inside of a range. We're sweeping the lows and we're sweeping the highs. This is your new range now. And then from a higher time frame perspective, you are bullish, because you have the daily buy side imbalance. And then you also have this 1 hour, inversion for like a forming. You're tapping up into the 4 hour bearish inversion. You're having this 1 hour candle range low sweep here. This does not look bad for longs. And if you go down to like a 30-minute time frame, again, you're inside of a 30-minute buy side imbalance. It did get inverse on the 15-minute time frame. You also had this little nice 15-minute candle range low sweep. 3-minute time frame, you have a 3-minute inversion for like got forming. This is where I messed up. I entered a little bit too early, and we're gonna go over that right now. So I entered this trade right around here, around, I mean, truly honest, around, I'm not too sure, but I entered around there, and I had a 50-point stop, and I got really, really cooked. So around something like this, I entered something like this, market just instantly came, wicked me down, and then it wicked me out, actually, I should say, not wicked me down. That sounds crazy. Pause, bro. That sounds crazy. Wake me down. Nah, the market wicked me out of this trade. Um, and then eventually it came down. It failed to sweep, and then eventually it pushed up higher, showing an indication that hey, we're having a failure swing once more to displace lower, and now we want to continue pushing up. And if you watch the recap, you can see that I was basically trading off of the correlation with ES. ES was pushing above. I expected in Q to you know, continue to the upside, and that's where the market failed to continue displacing higher and breaking above and forming that change in state of delivery. And as you can see there, the market just continued to turn that brightness on. The market continued, break down range a little bit, go above, and then eventually break down lower. So if we go down here, you can see that there the market eventually boom, 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 pushes up, and we have to start viewing it from a perspective like, hey, on the 5 minute time frame, this is okay. That's the mistake we made. We entered too early. We got wicked out too tight of a stop loss. So let's write this out real quick. So number one was tight stop loss. Trade wouldn't have been bad if the stop loss wasn't so tight. Suppose we had the, stop loss all the way down here. That wouldn't be bad, but we would have still got stopped out. Number two, early entry. What I mean by that is IPG not closed yet. So the IPG has not been formed on the 3 minute. And then number three is going to be no higher time frame, not using the highest IPG. So what I mean by that is the 5, 4, 3, 2, 1 minute IPG formation. Here on the 5 minute, we had a nice 5 minute IPG formation, but the market failed to give us that and close above. And so we entered off of the 3 minute one because again, it looked like it was going to form it, but again, we got humbled. Even then, if the market did form the 3 minute IPG, guess what? If the 5 minute hadn't formed an IPG yet, it could still most likely disrespect the 3 minute, and the 5 minute SIBI would continue to push price lower, even though we had a 3 minute IPG. That's why you use the highest time frame inversion, and then you look for other entry models inside of that inversion to then confirm the direction. So suppose you know, now let's go over the most bullish scenario here. Suppose we waited for the 5 minute closure off of this IPG, and we were like, hey, we want to target this intermediate term high, and that's where our break-even point would be. And after 9:45 is the most ideal optimal entry. So around right there, wait for that closure. Market closes above here. This is where you optimize your entry and you enter. Suppose you would want to manage risk accordingly here and enter the market in a state of, accepting risk, but also having a good amount of risk. Where would your ideal stop loss placement be? So if we go back up to the 5 minutes, suppose you enter there, most people would place their stop loss here, and you would aim for a target of above here, this high. That is a 1 to 1.3 ratio, which is not bad, but is not ideal if you're trading with, prop firms. You would usually want to aim for a 1 to 1.5 in my honest case scenario. And this would be like the most, basic trade idea scenario here that I could play out. And if I stuck to my plan and I stuck to my rules, this would be my trade idea. Why? Because we have a, oh my gosh, I keep hitting that. Just put this up here somewhere, something like that. So here we had a change in state of delivery, and then we had a 5 minute inversion. This looks nice. This looks like a nice setup. Suppose I use standard deviations for, the bodies, and I was targeting like a two standard deviation for the bodies here, and I aimed for this. This does not look bad. This does not look bad. I would take this 9 times out of 10, but guess what happens? The market just boom, boom, boom. You get stopped out break even, and then it dumps. Reason for going break even, you hit this intermediate term high, you wait for this market to inverse this right here, and then, you know, push above it, which it does. You would not want to see your break-even point be met. Why? Because you have a change in state of delivery. You want to see this high get broken through and breached above, and then, you know, continue to your standard deviation target here. Um, suppose now we go to the 1 minute. Suppose we go to the 1 minute, and I'm going to clean all the drawings up. Suppose you go to the 1 minute and you're looking to manage this trade more accordingly from a 1 minute perspective. Here's the most ideal scenario that I can think of from a 1 minute perspective. So you have this fair value gap right here that forms, and you also have the low of the fair value gap or the three candle formation. Um, right here, if you combine both of them, to me, this is how it looks. Instead of just using this fairly, if you would have got stopped out, bro. Not worth it. Combine both of them, but like to like a 2 minute, that would be ideal. But it doesn't have it there, so it's not. Um, you can use this 5 minute IPG as a means to what? Have the market rebalance and push you up higher. What I'm saying is you can have the market form a fairly up, retrace up into it, look for an entry, and that's where you go. So this is something I've been a little bit more on the experimental side. Still trying to collect more data. So this is what I'm talking about right there. Suppose you get an entry there, it's fine, honestly. And this is your trade. That's your trade. Look for a target, something like this. Boom. You have your 5 minute busy, market retraces, forms the inversion, and you also have a mitigation block forming or a change in state of delivery inside of the inversion. And it will look something like this. Suppose this is your trade idea. You take that after you close above the inversion, and you form the mitigation block and all that good stuff. So, but here in the scenario, you have a 5 minute, inversion, which is your, change in the state of delivery. You have a continuation off of the fair value gap. Suppose you enter off of that right there. This is where your original stop loss is, and you're looking to target this area right here. Guess what? That is a 0.5 risk reward. Suppose you're aiming for 1 to 1.5. You're so close, so close, so close, and you don't hit it. You don't hit the 1 to 1.5. But in 9 times out of 10, you would. And then that's having it at the body. I mean, the wick, imagine it having it at the body. You most likely hit your 1 to 1.5. So what I'm trying to say in this scenario is you have your higher time frame entry model, which you originally would enter off of, and then you have your lower time frame trade management model, which you would, use a PD array off of the 5 minute PD array here to, give you that confirmation. And again, it's something I'm still experimenting, something that you guys would usually want to continue collecting data upon and experimenting on. Because again, I am not a financial advisor. I do not, condone day trading, and it is very risky. So day trading is risky and you have to be willing to accept the risk. But yeah, this is my most ideal scenario of like a good trade right there, something like that. Especially after we inverse that 5 minute fairly up, I'm just looking to see like, hey, I'll go break even now. Market can, reverse here after we sweep this high, but we never swept it, and we had some form of SMT at the highs with the ES, and then the market started to dip. So we're gonna go over the bearish scenario here. I don't know why I was on the 5 minute. I'm in the 5 hour. So suppose you are on the 4 hour time frame and you're looking at the market from the lens of the 4 hour perspective. We have a 4 hour inversion to early up, and then the market what is respecting the daily buy center balance, but then we start to dump. Everybody's thinking like, oh my gosh, this is like the craziest dump ever. Um, we have a 1 hour candle range high sweep right there. Or not a 1 hour, we have a 1 hour external objective that is met from Asia session, and we are sweeping it. Sweeping it, and then on 9 o'clock to 10 a.m. we're sweeping the 9 a.m. high, unable to break above the other high, and we're continuing to the downside here. Suppose you go to the 15-minute time frame, you can see it a little bit more clearly, right there like that. And yeah, and right here, this high, we're unable to break above, and we're also unable to break above here and close above. You go down to the 5 minute time frame, you can see from the 5 minute lens, which I was displaying earlier. You can see the same thing: rejection, 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 hard displacement, continuation, rejection. Then we have more continuation to the downside here. Strong wicks also to the downside. Go down to the 3 minute. You also have a 3 minute CIBI. And again, this is what I was talking about of that lower time frame entry model. Suppose you go to the 1 minute. You have that 3 minute CIBI. Market goes up, inverses it, I mean, respects it, and then you inverse a 1 minute fair value up here. This is clearly your A plus setup slash entry. You have an easy break even point. Um, Trade idea. Suppose you're targeting this low right here. 1 to 1.8. Nice stop loss placement. I know a lot of people would go break even right here at this low, but I would not recommend that because again, you would not hit this trade. My ideal scenario, and again, this is something that I've been also experimenting with, is go back up to 3 minute. So for the 3 minute here, you have the 3 minute civvy, you have your price leg. Once this price leg is broken through and reached and breached upon, you form that change in state of delivery after you have this candle closure. That's when you go break even. Something again, I'm just experimenting on, just based off of market structure and just basic market foundation and understanding how the market mechanics are moving, and of course using order flow and price action charts, market structure, simple stuff like that. It's pretty generic, honestly. And the basics work. They humble you majority of the time. But yeah, and again, you can aim for your two standard deviation. Beautiful trade idea. Longs didn't play out. You look for the shorts play out. Boom, the shorts play out. Two trades. This is something I'm also going to be experimenting with, two trade limit. But again, grading setups, having dynamic risk. First trade would have been A plus, risking so much on that one. And then this one right here, probably risking a little bit lower. First trade I would have been risking like 3% if I was on eval. If I was on funded, 2%. And then the second trade, again, on eval, I would probably be risking 1.5%. And then on an express account or funded account, I would be risking around 1%. Um, Okay, again, it's not really my type of setup. You also have a 3 minute buy and balance right here, which again, if you were trading an inversion, you would usually wait for this, and then you would enter, go break even after you break below that low. You have a closure below it on the 3 minute, not on the 1 minute perspective. Because again, if you look at the 1 minute perspective, that's where you would go break even. Suppose you enter on the 3 minute before, on the 3 minute inversion right here. Guess what? Your break even point is all the way over here at 10.24, and then here your break even point is at 10.21. But either way, the 1 minute precise entry is what makes the difference. The timing, the execution, and of course the management behind it is what makes the difference. It makes the biggest difference, I promise you. Suppose you were trying to enter over the 3 minute inversion as opposed to the 1 minute inversion. You see how delayed your entry is compared to the 1 minute inversion. It doesn't make sense. It doesn't make sense. Why not just wait? And yeah, also something I'm experimenting. So here you can just, from a hindsight perspective, of course, you can just tell that the market is bearish. You can tell the market is bearish and it continues to dump and it continues to break. Now you're forming your range. This is where you form your range. Market compresses right there. And guess what? Breaks below the range. And then you continue to try to find some form of acceptance, and then you do. And then boom, this is your new range. Break above your range, coming back into the range, and then you're breaking below the range, trying to find acceptance lower. You do, and then eventually you continue breaking below. Now you're forming a new range, you're breaking below it, you're retesting it, see if you can go lower. Market does not want to go lower, it's finding less and less volume for the big holiday comes into place. So yeah, this is your new range right here, right here, and then eventually you form in another range right around here. And you continue to the downside, try to break below it, you do, you retest, trying to continue lower. And then you find higher prices. All right. But yeah, I all sorted up here. Study hard time from PDRA. I'm gonna clean all this up real quick. One of the big key things we're using here is failure swings. You can see that the market here failed, formed that 1 minute inversion, broke above this high right here, showed continuation and acceptance for higher prices. And that's something I'm really trying to study on, which is failure swings, and then eventually also external sweeps. So if the market did sweep below this low, or if it did break below this low, and then we retested and formed another inversion to continue lower, which you saw here in this case study, it's kind of like the most ideal scenario you would want to see, honestly. And then let's go to Wednesday's perspective, honestly. Go right here. So this is where Wednesday's case study was, right around here. Go to the 1 day. I always start my analysis on like the higher time frame. On the daily perspective, we're in here, we're compressed inside of a range. 4 hour, we're inside of a 4 hour PD array. We have this 4 hour candle range low. Go to the 1 hour time frame, just using market structure. We're breaking below the market low. We also have this high up here, which is our market range. High 15-minute time frame. You can see here from a 15-minute perspective, imbalance ratio right there. You go to a 5 minute perspective here. This is the range low. Then again, you have a little external sweep, and then this is your range high up here. To me, it looks a little bit more bearish. Looks a little bit more bearish, even though we're digging into a higher time frame PDRA. And then eventually the market opens. Boom, boom, boom. We break down lower, continue to the downside. And this is where things get a little bit more tricky. We go back up to the 5 minute time frame. You have your new range, and you have a new 5 minute PDRA. And this is where you would want to see the market start to show more acceptance for lower prices and form that lower time frame change in a state of delivery, break below this low, continue to the downside, and aim for, more sell side objectives. I don't have them marked out, but you would aim for more sell side objectives here on a Wednesday's perspective. But you don't get that. You get the opposite. The market actually, tries to push down lower and it doesn't. And then you also have a mitigation block inside of your higher time frame PDRA form to continue to the upside, which goes to show sellers were in control. The market tried to push down lower, break below value, area low, but now it's trying to show some form of recalibration to what? Reach back to point of control, if not, reach the value area high and bounce between value areas, which again is like showing mean reversion here. This is like where your reversion level is, and then eventually the market is pushing up higher, going back to like, standard VWAP area. And this is where your first straight up setup would present itself throughout the week. This is like an A plus setup. Again, rejection blocks are the most ideal areas to put your stop loss. The wicks are nice, but I feel like this is all manipulation. This is all manipulation, and you would not want to see the market retest that, especially after forming all this right here. You would want to see at least 50% of this area hold, especially the upper quadrant, if you're going to be bullish. And that's mainly due to the fact that we're at such a low area of, in terms of mean reversion and standard deviation, you would want to see speed to, acceptance. It's an area where price would want to be accepted and start ranging, as opposed to, reaching back into the area where you're below value. But then the market, see what it does. And again, stop loss or take profit would be up here at your range high, the new range that you formed on the 5 minute perspective. After sweeping this low and showing bearish signatures, but the prices or the market is not giving you what you would want to see. And then you have a fair value at form, market retraces up into it, shows a strong wick right here. Continue to the upside, boom, boom, boom. And then target is met. 4 1 to 2. Again, that's 2 to 1 to 2 scenarios. First, this is the longs. Second is the highs. Right here, target inside. You're probably wondering, like, Why would you want to take longs? I mean, you were inside of a 5 minute CB. We have another one up here. We have the range breaking below. We also were inside of the 4 hour PDRA, but we also have a 15 minute, PDRA. And it's all about context, in my honest opinion. Because again, they're like thinking, you're probably thinking like, what if this, forms an inversion after, tapping up into the city, and then we push above higher and continue to the upside. And why don't you just wait for the 5 minute PDRA to get inverse to then eventually take the trade? Is probably your bet. You're probably thinking that, and you're probably thinking like, why are you taking the trade right now? And again, it's all due to context. If the 5 minute CB was going to hold and push price lower, this right here, especially this wick too, would have held and closed below this. But the market never did that. And the market continued and it broke above this right here. And again, mean reversion. We are below a value area. We're also breaking below the range low. External sweep continues to the downside. Strong distribution here. This price leg, you would want to see the market retrace, push down lower, break below this, but it never gave you that. It never gave you that. So the opposite is going to happen here. This is all going to be a form of a jitter swing, and the market is going to continue higher. And now let's go to Tuesday's example of what you would want to see. And that's honestly what it gave us for Tuesday's example. And why didn't you want to take, probably thinking like, oh, why don't you take this? Because again, you can see Tuesday's example also honestly give you the same thing, but it never formed it. Why didn't we just close below? And then eventually, suppose we did close below this and we continued to the downside and broke below these, the 5 minute and the 15 minute P area. Never happened. And then for longs, let's go over the long scenario. Closed above here, closed above, stop loss not at the rejection block. We would have got stopped out. 5 minute time frame. Let's go to it. And the reason why I didn't like that 1 minute entry was because of that. We don't have any form of context or higher time frame here. If it goes like a 4 hour time frame, you don't have anything there. Right here. This is your candle. You have a 4 hour candle range low sweep. But in terms of mean reversion, the market is against you here. And it's not worth it. Um, so again, you have to be like if you're a trend type of trader, this is where your things get a little bit more tricky. We go like down to the 15 minute time frame, nitty gritty. 5 minute, you have a 5 minute period there. You have a 5 minute buy side imbalance tapped up into. Why is this trade not good? Because again, you're way above mean reversion in terms of being bullish. You would have wanted the market to push down lower, sweep these lows, and then continue to the upside. And in a trend-based model, you would want to see an IPG form and then a change in state of delivery above here to then take your trade instead of taking one inside of here. And that's another thing too. That's why this one was more lower probability compared to the other one.